I have been thinking a lot about the changing global landscape, and I'm ready to share my thoughts. So, Iran just closed the Strait of Hormuz, and gold and silver went down, not up, down. The world's most powerful geopolitical shock since 1973 landed 2 weeks ago. You are probably watching your portfolio right now with a deep sinking feeling in your stomach, completely consumed by fear and panic as you see your precious metals position suddenly underwater. You are deeply confused, and rightfully so, because basic logic dictates that when global chaos erupts and missiles fly, safe haven demand should have instantly surged, sending prices to the moon. Instead, the exact opposite occurred, destroying the emotional stability of millions of investors worldwide. This is the precise moment where the foolish retail investor gets completely shaken out of their positions, selling their physical assets at a massive loss because they let pure anxiety dictate their financial decisions during a crisis. They look at the rapidly dropping spot price on their screens, assume the protective narrative of precious metals is entirely dead, and they surrender their wealth directly to the very institutions that are actively suppressing the market. But the smart structural investor does not panic. The smart structural investor understands that this counterintuitive price action is nothing more than a temporary, highly manipulated illusion designed to steal your wealth before the most violent upward repricing in human history. We are standing on the precipice of an epic financial transformation, and if you can simply understand the hidden mechanics behind this sudden drop, you will transition from a state of paralyzing fear into a state of absolute, unbreakable confidence. Imagine for a moment that it is March 2026. And you are looking back at today's exact geopolitical event. In March 2026, the global energy supply chains are completely fractured. Inflation has utterly devastated the purchasing power of the fiat dollar, and the people who sold their gold and silver in panic today are living with the devastating regret of missing the greatest wealth transfer of our generation. You do not want to be that person looking back from March 2026, wishing you had understood the true macroeconomic picture. The mainstream financial media, networks like CNBC and Bloomberg, will never explain the reality of this situation to you because their primary objective is to keep you confused and reacting emotionally to short-term noise. They want you focused on the sudden drop so that you ignore the massive structural forces building beneath the surface. To survive this, you need to understand the hidden algorithms and the bond market mechanics that are secretly driving this counterintuitive price action. Subscribe now. You must secure your access to this unfiltered truth before the window of opportunity completely closes, because the information I am about to reveal is the exact blueprint used by the most elite financial institutions on the planet. Let me say what is actually happening behind the curtain of this chaotic market reaction, because the truth will immediately alleviate your anxiety. The reason gold and silver crashed when the Middle East erupted is entirely dictated by the 10-year U.S. Treasury yield and an invisible mathematical trigger I call the 0.4 suppression mechanism. When the geopolitical shock of the Strait closing hit the global markets, the immediate knee-jerk reaction among massive institutional computer algorithms was a massive flight to extreme liquidity, which caused a sudden, sharp spike in the US dollar and a corresponding violent upward spike in bond yields. Specifically, when the 10-year U.S. Treasury yield spikes rapidly by a certain margin, these automated algorithmic trading systems are programmed to indiscriminately dump non-yielding paper assets like gold and silver. It is a completely blind, emotionless, mathematical reaction that has absolutely nothing to do with the actual physical supply or demand of the metals. The algorithms do not care that a massive historical supply deficit is currently brewing in the physical market, nor do they care that the COMEX registered inventory is being violently drained at an unprecedented historic rate. They simply read the widening yield spread and blindly execute massive paper sell orders, artificially suppressing the global spot price and creating an extreme, terrifying divergence between the fake paper market pricing and the absolute reality of the physical market. The paper price crashed, but the physical demand simultaneously exploded, with premiums on physical bullion surging globally as smart money quietly scooped up everything in sight. This artificial paper suppression suppresses the true value, but it cannot last, and we can prove this by looking directly at historical pattern repetition. We have seen this exact same setup before, and the outcome is always identically explosive. Look back to the massive 1973 oil shock when a similar geopolitical crisis gripped the world. The initial reaction in the financial markets was sheer panic, liquidity violently dried up, and precious metals actually experienced a brief, terrifying drop that shook out the weak hands. But once the brutal reality of sustained structural inflation and permanent geopolitical tension set in, the algorithmic suppression was entirely blown away and the price of gold absolutely surged, eventually quadrupling in value as true safe haven demand overwhelmed the paper manipulators. We saw the exact same phenomenon repeat during the 1979 crisis, another massive geopolitical shock, another brief period of manipulated downside volatility, and then gold exploded perfectly into a parabolic historic bull run. The historical parallels between those crises and today are absolutely undeniable, but the stakes today are infinitely higher because the underlying structural rot in our modern financial system is exponentially worse. To truly grasp the magnitude of the violent upward explosion that is coming, you must understand the three-layer structural thesis that guarantees the unthinkable is about to happen to both gold and silver. Layer one of this thesis is the permanent geopolitical oil shock that has just been triggered. With Iran effectively controlling the most critical choke point of global energy transit, we are instantly locked into a period of sustained, structural, unbreakable inflation that absolutely cannot be fixed or papered over by central bank monetary policy. You simply cannot print millions of barrels of oil out of thin air. When energy prices remain structurally elevated for years, the fundamental cost of producing everything on Earth skyrockets, and most importantly, the massive energy costs required for mining new gold and silver go exponential. This energy crisis creates a permanent, impenetrable floor under the physical price of precious metals, guaranteeing that the era of cheap metals is permanently over. Layer two of our structural thesis is the absolute, mathematically terrifying reality of the United States national debt, which is the ultimate catalyst for the coming price explosion. We are currently sitting on an incomprehensible $36.2 trillion of sovereign debt, a number so astronomically large and toxic that it completely defies basic human comprehension and destroys any mathematical model of sustainability. The interest payments alone on this $36.2 trillion burden are now violently consuming the entire federal budget, creating a terminal debt spiral. It is a mathematical impossibility for the United States government to sustain this crushing debt load without aggressively and deliberately debasing the underlying currency. The 10-year U.S. Treasury yield, which is currently suppressing the price of gold, simply cannot stay elevated forever because high yields would literally bankrupt the entire United States government within a matter of months. Therefore, the Federal Reserve will be absolutely forced, against their will, to step in and aggressively cap those bond yields, implementing extreme yield curve control to save the sovereign state from total default. The very second they pivot and implement this yield cap, the artificial 0.4 suppression mechanism on gold and silver is instantly and permanently blown away. The spring will uncoil with maximum fury, and the sudden influx of hyperinflated liquidity will act as pure rocket fuel, sending precious metals surging upward in a violent, uncontrollable structural bull market. Layer 3 of our thesis is the unprecedented, dangerously extreme physical silver divergence that is currently breaking the global market. The COMEX registered inventory has been drained to dangerously low critical levels, while the relentless industrial demand for physical silver, driven massively by global solar panel production, advanced electronics, and crucial military hardware applications, has created a permanent structural supply deficit that mathematically cannot be resolved at current prices. Furthermore, the gold-silver ratio is currently stretched to absurd, historically extreme, and mathematically unjustified levels, forming a massive multi-year macroeconomic cup and handle pattern that is desperately begging for a violent upward breakout. When you combine these three layers, a permanent geopolitical oil shock, a mathematically unpayable $36.2 trillion debt burden requiring immediate and massive currency debasement, and an extreme physical supply deficit in silver, you create a perfect, unstoppable macroeconomic storm of truly biblical proportions. The smartest money on the planet knows this reality intimately, which is why the massive institutions are not panicked by this recent orchestrated drop. Instead, they are aggressively buying the dip and quietly accumulating physical metals, while the foolish retail investor cries over their underwater paper positions. Here is where things get incredibly important, and why you must immediately abandon your fear and adopt the mindset of the absolute financial elite. You need to stop listening to the emotional noise on television and start looking precisely at what the highest level authorities in the financial world are actually doing with their capital. Ray Dalio, universally recognized as one of the most brilliant and successful hedge fund managers in human history, has explicitly and publicly laid out a definitive investment framework that points directly to the mandatory accumulation of hard assets during periods of shifting global empires and inevitable fiat currency devaluation. Dalio understands the absolute certainty of historical pattern repetition better than anyone alive, and his proprietary macroeconomic models clearly indicate that we have reached the absolute end of the long-term sovereign debt cycle. When this terminal debt cycle ends, the fiat currency must be aggressively devalued to save the state, making physical gold the only mathematical safe harbor. Similarly, J.P. Morgan, the exact same massive financial institution that has historically been accused of aggressively suppressing precious metals prices in the paper markets, is now openly projecting massive, unprecedented structural price targets for gold over the next decade. They are quietly and methodically accumulating physical metals by the ton, while the retail public is deliberately distracted by the temporary chaos of the Middle East conflict and the illusion of the stock market. J.P. Morgan understands that the unpayable $36.2 trillion debt is the ultimate, unavoidable catalyst that will shatter the current financial paradigm. They know exactly why central banks worldwide have been aggressively hoarding physical gold at a record-shattering pace, quietly accumulating a staggering 863 tons of gold in recent months, which officially marks the highest level of central bank gold buying in recorded human history. You must ask yourself a very simple, profoundly revealing question. Why would the most powerful, deeply connected financial entities and sovereign central banks on the planet be urgently hoarding massive quantities of physical gold while the paper price crashes on your screen? The answer is because they know with absolute certainty that the current fiat system is irreversibly breaking. They know that the current paper price is nothing more than a highly manipulated temporary fiction deliberately designed to allow them to accumulate real, tangible wealth on the cheap before the inevitable upward explosion. The glaring contrast between the artificially suppressed short-term paper price and the mathematically guaranteed long-term structural price represents the single greatest financial arbitrage opportunity of our entire generation. When you fully internalize this powerful contrast principle, the debilitating anxiety over your temporarily underwater investments instantly and permanently evaporates. You suddenly realize that you are not wrong in your fundamental thesis. You are simply early, and being early is exactly how generational wealth is built during a structural paradigm shift. The paralyzing fear of geopolitical instability is rapidly replaced by the supreme, unshakable confidence of possessing true insider knowledge that the masses lack. You are no longer the confused, reactionary retail investor who buys high and sells low out of panic. You are now firmly part of the smart money minority, calmly executing a highly calculated, historically proven accumulation strategy while the rest of the world drowns in manufactured chaos. This is fundamentally about securing your total financial sovereignty in a world that is rapidly and intentionally descending into geopolitical and economic madness. Let us dive even deeper into the specific, undeniable mechanics of this impending wealth transfer, because understanding these granular details is exactly what separates the generational winners from the tragic victims of inflation. When we meticulously examine the massive cup and handle pattern that has been forming on the long-term macroeconomic charts, it is absolutely critical to understand that this is not just some arbitrary technical indicator drawn by day traders. It is a profound visual representation of decades of deliberately pent-up, kinetic financial energy. The handle of this massive pattern has been meticulously forming precisely during this current period of intense geopolitical turmoil and relentless algorithmic yield suppression. Every single time the 10-year U.S. Treasury yield spikes and the automated algorithms blindly dump paper gold, they are simply compressing the macroeconomic spring tighter and tighter within this technical handle, building up a level of tension that is becoming mathematically and physically unsustainable. You must deeply realize that the physical bullion market and the paper derivatives market are currently operating in two completely isolated, totally different realities that are about to violently collide. In the fraudulent paper market, a single ounce of gold is routinely rehypothecated, leveraged, and traded dozens of times over, creating a dangerous illusion of infinite liquidity that tricks the retail investor. But in the harsh reality of the physical realm, the supply deficit is glaringly, terrifyingly obvious to anyone paying attention. Global refineries are currently struggling to source raw materials. International mints are experiencing unprecedented production delays, and major sovereign nations are aggressively demanding absolute physical delivery of their bullion, urgently repatriating their national reserves from foreign vaults back to their own sovereign soil. This massive global repatriation movement is a blaring red flag signaling that fundamental trust in the global financial plumbing is completely and irreversibly broken. When Iran triggered this massive recent geopolitical shock by closing the strait, it exponentially accelerated this global loss of trust, forcing nations to realize that holding U.S. treasuries is a massive, fatal strategic vulnerability. If the United States government can arbitrarily weaponize the dollar and freeze the sovereign assets of foreign nations, then the only true mathematically viable safe haven demand must immediately flow into a tangible asset that possesses absolutely zero counterparty risk. That ultimate pristine asset is physical gold and physical silver. This is exactly why the terrifying temporary price crash you just witnessed is actually the most incredible financial gift you will ever receive in your lifetime. It is the absolute final closing opportunity to exchange your rapidly depreciating fiat currency for deeply undervalued physical wealth before the entire paper illusion shatters completely and prices reset violently higher. Imagine the sheer, unadulterated panic of the massive institutional short sellers who are caught trapped in the fraudulent paper market when the available physical metals finally and completely run out. We are talking about a physical short squeeze of such epic, historical, and violent proportions that it will make every single previous market event look like a microscopic blip on the radar. The absolute fury of this structural bull market will be unleashed the exact moment the Federal Reserve is mathematically forced to pivot and begin monetizing the impossible $36.2 trillion debt burden. It is absolutely not a question of if this will happen, but only a question of when, because the harsh mathematical reality of our total fiscal dominance mathematically guarantees this outcome. The government simply cannot afford to pay higher interest rates, so they must inevitably print trillions upon trillions of new, worthless dollars to buy their own toxic debt, completely destroying the remaining purchasing power of the currency in the process. This inevitable hyper-monetization is the ultimate unstoppable catalyst that will send gold and silver surging to completely unimaginable, historically unprecedented heights. When this highly anticipated event finally happens, the upward price action will be so violent, so rapid, and so completely unstoppable that you will absolutely not have time to react if you wait for the mainstream financial media to officially confirm the trend. By the time the talking heads on CNBC finally announce that gold has exploded and the bull market is real, the smart structural money will have already secured their massive positions at the bottom, and you will be left hopelessly chasing a runaway train at massive premiums. This is the tragic, highly predictable fate of the foolish retail investor who is constantly reacting emotionally to yesterday's news instead of intelligently anticipating tomorrow's structural macroeconomic shifts. But because you are here, you now possess the profound knowledge required to completely avoid this devastating financial fate. You deeply understand the profound, historically validated implications of the 1973 and 1979 historical parallels and how they guarantee an explosive upward resolution. You clearly recognize the profound hidden importance of the 0.4 algorithmic suppression mechanism and exactly how it temporarily masks the true, exploding intrinsic value of precious metals during a crisis. You see the absolute, undeniable truth in the powerful three-layer thesis, the permanent geopolitical oil shock, the mathematically crushing weight of the unpayable national debt, and the extreme, unresolvable physical silver divergence. You are now fully armed with the exact same elite macroeconomic framework utilized by legendary investors like Ray Dalio and massive financial institutions like JP Morgan. These institutional giants are currently projecting a massive $6,500 price target for gold, and they are not making this prediction as a wild speculative guess, but as a cold, hard mathematical certainty based directly on the unavoidable expansion of the global fiat monetary base. When gold inevitably hits that $6,500 price target, the dangerously stretched gold-silver ratio will absolutely and inevitably collapse from its current extreme. Manipulated levels rapidly back down to its true historical average. If that crucial ratio drops back down to a conservative 30-1, or even returns to its historical monetary peg of 15-1, the corresponding price of physical silver will violently surge to levels that most ordinary people currently consider to be entirely impossible and mathematically absurd. We are talking about future silver prices that will completely and permanently redefine the fundamental concept of generational wealth for anyone smart enough to position themselves today. The unthinkable is indeed about to happen to both gold and silver, and the mathematical data proves that it is going to happen much faster, much harder, and much more violently than anyone in the mainstream financial media currently anticipates. The dramatic closure of the Strait by Iran was merely the initial opening salvo in a much larger, globally catastrophic economic war. It was the precise geopolitical trigger that finally exposed the extreme critical fragility of the entire global financial system. You must immediately cast aside your emotional fear, completely ignore the deliberate algorithmic manipulation of the fraudulent paper markets, and fully embrace the supreme, unbreakable confidence that comes directly from understanding the true underlying structural macroeconomic forces currently at play. The brief window of opportunity to accumulate these deeply undervalued assets is closing rapidly, and the greatest, most profound wealth transfer of the 21st century has already officially begun behind closed doors. Position yourself accordingly right now. Hold your physical precious metals assets with an absolute iron grip. Entirely ignore the daily paper volatility and prepare yourself mentally and financially for the absolute most spectacular, violent, and highly profitable structural bull market in the entire recorded history of precious metals.